Welcome to this explainer. Today, we're going to break down exactly how regular monthly investing transforms into explosive growth over time, all thanks to the math of compounding. You know, if you've ever felt like your savings are just sort of crawling along, this one is absolutely for you. We're going to look at the real numbers behind a portfolio to show you how a standard monthly contribution eventually stops being just a savings habit and actually turns into a self-sustaining wealth engine.
Here's our game plan for today. We'll cover the $500 monthly habit, break down the actual numbers, look at the sheer speed of compounding, project this engine into the future, and finally, dive into the tax-free advantage. Let's get right to it. Starting off with Section 1, the $500 monthly habit, and how small beginnings add up. Everything we're looking at in this explainer is anchored around one super simple, beginner-friendly move, an investor deciding to contribute exactly $500 every single month. That's the baseline. No massive lump sums, no complicated trading strategies, just putting $500 away month after month. And here is the timeline of that dedication. From January 20th, 2020, all the way to June 2026, this investor stayed the course for 78 straight months. Through the ups, the downs, and everything in between, exactly $500 went into the account, building the solid foundation we are about to analyze. Moving on to Section 2, breaking down the numbers to see exactly where we are now.
So over those 78 months, the investor actually only put in $39,000 of their own money. But look at this total account size. It is completely swelled to a market value of $63,972.86. That means nearly $25,000 of the pie, well, $24,972.86 to be precise, is pure investment growth sitting right on top of the contributed money.
Now, you might also see a term called book value on your own statements. In this case, the book value is $45,763.46. Wait a minute, that's about $6,700 higher than the $39,000 actually contributed, right? Well, that's because this number includes all your automatic reinvestments, dividends, and distributions along the way. It's the true cost value of the account when you factor in all that internal activity. So here's the real kicker. The current market value of the investments is actually worth about $18,209 more than their book value. This shows some incredible embedded growth. Your money is actively generating its own value, pushing the actual worth of the account far past what you've manually put in and reinvested. Okay, on to Section 3, the speed of compounding, where we really start shifting gears. When you take that nearly $25,000 gain and divide it by our 78 months, you realize something pretty amazing. While you were working hard to add $500 a month, the investments themselves were right there beside you, adding an average of about $320 every single month in growth. You're no longer working alone. Your money is acting like a highly productive coworker. I do want to pause here for a second because, honestly, it's totally normal for this to feel like a slow grind at first. Early on, your balance is small, so even with a fantastic estimated annualized return, let's say around 15% per year, which is what this account averaged, that 15% just doesn't equal a huge dollar amount when it's applied to a tiny starting balance. This brings us to Section 4, projecting the future engine, and seeing what accelerated growth really looks like. Now, I need to be radically transparent here. The golden rule of investing is that the future is never guaranteed. Markets go up, markets go down, that's just a fact. But if the future performs anywhere similar to the past, projecting these historical returns helps us visualize how the mechanics of compounding actually speed up over the next 5 to 10 years. Just look at these projections. If that $500 a month continues and past growth rates hold up, check out the 10-year mark. Your total out-of-pocket contributions would only be $99,000, but the estimated balance, it absolutely balloons to over $400,000. That is over $300,000 of pure growth simply because that same percentage return is acting on a much, much larger base. This is the literal magic of compounding in action. Think about it. Your manual contribution stays completely flat at $500, but in 1 year, the account could be growing by $855 a month above your input. In 5 years, $1,340 a month. And in 10 years, the market is practically dumping well over $2,300 a month onto your wealth pile. If you take away just one thing from this explainer, let it be this. You are no longer just manually building this account. That first stage was all about building the base. But now, the investments are doing the heavy lifting. The base itself is doing the work for you. And finally, Section 5, the tax-free advantage and how to protect this engine you've built.
A massive estimated balance of $400,000 sounds fantastic, right? But you gotta ask yourself, how much of those hundreds of thousands of dollars in gains is the government going to want? In a standard account, you lose a slice of your growth to taxes every single year, which literally taps the brakes on your compounding engine. But if you're in Canada and using a TFSA, a tax-free savings account, this growth gets immensely more powerful. By holding these investments inside a TFSA, that compounding snowball is entirely sheltered. All that investment income, the dividends, the capital gains, they can grow completely tax-free. You don't lose a single cent of that momentum, as long as you follow the CRA's rules and stay within your contribution limits.
The math doesn't lie. Consistency up front allows compounding to eventually take the wheel. Thank you so much for joining me for this explainer. As you look at your own monthly $500 habit, I want to leave you with a question to reframe your whole financial journey moving forward. Are you just saving your money, or are you actively building a tax-free engine?